What is going on, beautiful people? It's Joe, aka the Nomad Investor, where dividends, freedom anywhere is the goal. And today we are back with another portfolio update for you guys. If you are new here and you haven't already smashed that subscribe button, please do so. It helps keep me motivated to continue making these videos and documenting my journey. And for those of you who are already subscribers and are back watching the videos again, if you could smash that like button, that would mean so much to me and also help with the YouTube algorithm. So without further ado, let's dive right in. We are currently at 984 subscribers, so we're close to getting that 1,000 subscriber mark. So again, please help me, guys. We are at 34 videos. I'm currently filming the 35th video, and I am filming the 33rd portfolio update. As always, the videos on this channel are for informational, entertainment, and educational purposes only. I am not a financial professional or advisor, and nothing here should be taken as financial, investment, or tax advice. Investing always carries risk, and those seeking financial advice should seek out a registered professional. Now, if you're new here, this is my game plan and goal for growing my small portfolio from $0 to $1,000 per month in dividend income. I have two sources of income currently. One is remote work income. It's pretty stable, pretty consistent. And the other is business income, which fluctuates up and down depending on the seasonality of things. And I have committed to contributing anywhere from $300 all the way up to $1,000 plus per month into my Robinhood taxable brokerage. And I'm treating this brokerage like a business, aiming for 30% plus high yield. Now, the way that I plan on achieving that is through investing into high yield income ETFs, such as, but not limited to, WPay, HOW, QDTE, XDTE, XPay, blocks, and more. And I have told myself that I'm going to be having a max of 5 positions where I'll be alternating between anchors and satellite ETFs. And I'll be reinvesting the weekly or monthly dividends depending on the funds that I'm going to be invested in at that time. And I'm going to be doing a manual drip versus an automatic drip. So basically, I'm going to be stacking the dividends to purchase whenever the market is down. This is much better because rather than doing like market orders or market buys where you're going to be getting a higher price filled, I'm going to be doing limit orders where I can control what price I'm getting in at or even get better. So that is why I'm doing manual drip instead of automatic drip. So drip plus always compounding is the portfolio growth strategy. And I'm going to be rinse and repeating this until my account hits $1,000 a month in dividend income. And again, none of this is financial advice. This is strictly for entertainment purposes only. I am some random guy on the internet, so you shouldn't copy me, nor would I ever recommend you copy me in any capacity. Moving on, for those of you who are interested, these are my dividend income milestones while I grow my small portfolio. I created this so that way I can celebrate the small wins leading up to the bigger goal along the way. So previously we have already completed or accomplished our first and second goal, and I am on track to achieve this month my third and fourth goal, possibly even the fifth or sixth. We shall see. It depends on how the market continues to perform and how distributions continue to pay out. So to be determined, but yeah, we are in a good spot. I am completely happy and confident we will at least get the third and the fourth goal accomplished. And that was kind of basically what I set as the base for me for this month. Now, diving into the portfolio on Robinhood, we are currently sitting at $6,697.61 for the day, or the pre-market, I should say. We're up 2.49%. As you can see, my buying power is currently $2,429.82. My margin buffer is sitting at 47.47%, which is equal to $3,149.11. My margin that's been used is currently sitting at $5,010.24, but my margin total is $7,440.06. Now, diving right into each position, first we have WPay, which is currently sitting at $51.20 a share. My market value is $6,144.77. I am currently down $88.39 or negative 1.42% on this position. My average cost per share is $51.94. I have 120 shares and my portfolio diversity is 52.48% with a maintenance ratio of 30%. And if we scroll down, we have not received our weekly dividend that usually gets paid out today. And that's because yesterday was Veterans Day. And as a result, there's going to be, I think, a one business day delay in payments. Moving on to HOOW, it's currently sitting at $65.06 a share. I have a current market value of $3,253. I am up $51.36 or 1.6%. My average cost per share is $64.03 a share. I have 50 shares and my portfolio diversity is 27.78% with a maintenance ratio of 30%. And as you can see, my dividend payout for this is still pending. Next, we have NVDW, which is currently sitting at $47.68 a share. My current market value is $1,716.48. I am up $89.99 a share or 5.53%. My average cost per share is $45.18. I have 36 shares and my portfolio diversity is 14.66%. with a maintenance ratio of 30%. And then last but definitely not least, we have my KQQQ position from Curve. It's sitting at $29.68 a share. My market value is currently $593.60. I am up $18.50 or 3.22%. My average cost per share is $28.76. I have 20 shares and my portfolio diversity for this one is 5.07%. with a maintenance ratio of 25%. Now, this is my only monthly payer. Everything else is a weekly payer. Real quick, I wanted to dive into my investing journal. This is something that I've been using to log my portfolio performance since the very beginning. But I really quickly wanted to touch on, as you can see, yesterday our net account value was around $6,846. Obviously, today we are at only $6,697. So we are a bit down. And I don't know. I'm currently not really sure on how things are going to be going today, but I'm thinking it's going to probably continue to be chopping sideways until we get a very definitive decision from the House on the government reopening. But something to keep in mind is that the government will continue to reevaluate this decision come January 2026. So it's not even going to last that long, even if they do reopen it. Now, real quick, I am hopping into the dividend sheet here, and I wanted to highlight the market return and total return of each of my positions. So currently we are sitting at 7.38% for HOW, 0.98% for WPay, 7.81% for NVDW, and 3.2% for KQQQ. Now, something to note about this total return is it includes the dividends that I have received for the positions that I have here, if I've received a dividend from them, but these prices or these total return percentages are actually calculated based on the closing price of the previous day. So it's not going to be pulling the data pre-market, which is what we're currently at right now. But once the market opens, it'll update. And then for market return, we are currently sitting at 0.44% up for HOW, negative 1.91% for WPay, 3.90% for NVDW, and 3.2% for KQQQ. So everything pretty much is in the green in terms of total return, and everything except WPay right now is in the green for market return. So we're looking good. And then for those who are curious, this is how much I've gotten paid in dividends so far this month, which is $184.29. And for the year, we have received $500.60 in dividends. Now, real quick, I wanted to hop into X and share some posts with you. But before that, if you aren't following me on X, I would really appreciate it if you could do so. I currently have a goal to reach 100 followers before the end of this month. And if you follow me on here, you can get live updates from whenever I purchase things, any updates regarding distributions, new funds, my opinion on certain things that are going to impact the stock market as a whole, and more. So you can follow me at I'm Nomad Investor. Again, that's I'm Nomad Investor. This was a debate between two people or two accounts that I like to follow. One is Dividend Rob and the other is High Yield Hustle. So Dividend Rob said, another green day for SCHD. Haters will say, I'll stick with my 15% yield ETF. That's down 40%. So he highlights this, and as you can see, it was only up 0.13%. And then High Yield Hustle comments, here's high yield funds with a growing NAV since inception, designed for sustainability. Remarkable uniformed take. And so as you can see, it shows SCHD at the bottom at 0.80%, all the way to the other high yield income funds that he's listed here. So Blocks is up 38.34%. Chippy is up 59.12%. And then he said inception early this year, question mark, laughing emoji. And then High Yield Hustle said option selling has been around since 1973. The only thing new is it being packaged in an ETF. You think everything runs a synthetic strategy like Yield Max. That couldn't be more false. I'll harvest my dividends through the best companies in the world over SIGs and oil every day. If I wanted to burn my money, I would choose T-bills over SCHD. And then High Yield Hustle also says, and here's 3 years plus for you. To which you'll say zoom out, which is pointless because SCHD's holdings aren't relevant in the new global economy. So in this one that he posted, it's comparing JEPQ and SCHD. As you can see, JEPQ for a maximum time frame. So this is from May 4th, 2022 to November 10th, 2025, is up 69.32% versus SCHD's only 19.56%. So very interesting take. I know there's a lot of people in the debate between the traditional dividend ETF world and the new high yield income ETF world. Honestly, I think there is a healthy medium. I see the value in holding traditional dividend ETFs, especially once you reach a certain higher portfolio balance. But if you're probably in that much lower portfolio balance or even mid-tier portfolio balance, I could see a case being for investing into high yield income ETFs. The thing is, a lot of these funds are still relatively new, less than a year or two out. But something to note is I think there is a healthy medium where you can hold some traditional and some high yield ETFs in your portfolio as a whole and just kind of allocate them accordingly. So that way, one benefits the other and vice versa. Next, we have this X post. It's from a guy by the name of George or Behizzy tweets. It says, I don't see why people are complaining about the 50-year mortgage plan. Yeah, the banks are going to profit massively, but most people just want to be able to afford their monthly living expenses. Besides, how many home buyers actually finish their current mortgage term? You'd actually be surprised. There's actually quite a bit of people who do finish their mortgage term. And if they don't finish it, they probably have already sold it and technically would have been able to pay off the mortgage and profited. So that's just something to note. And I'm not completely disagreeing with George. I can see the sentiment, but I will say it's just not a financially smart decision. Anyway, so Paradise Mint says, when the market goes sideways, who is on the hook for all those loans that get defaulted on? It isn't the Federal Reserve. It is the American taxpayer. That alone is good enough reason to be upset about it. Make the banks 100% liable for the loans instead of the American taxpayer. I gotta agree with Paradise Mint on this. This is also a big concern of mine when it comes to the 50-year mortgage. There will be defaults if someone isn't selling their property for profit. And there is no guarantee that if we were to move forward with this plan, and at the current rate of the debt that the US has accumulated, and at the rate that we are printing US dollars, which is devaluing our currency, which is devaluing our buying power, at the rate that we are increasing our tariffs, which is causing inflation and the cost of living to significantly rise. There's no guarantee that the housing market is going to be able to withhold. And I'm not saying it's going to crash to the point where people are not making any profit, but again, 50-year mortgage, I showed you guys the numbers. If someone purchased a home at 35, give 50 years, that's 85 years old. But I did comment on this in a different way. I said, why am I not bullish on 50-year mortgages? This is one of my many reasons why. Because it places people to perpetual debt. So here is an example. A $500,000 house, 3% interest rate, $2,108 a month payment. The mortgage is only for 30 years and total interest payments are $257,887. Now, again, I spoke about this in my last video yesterday. If you're gonna have a 50-year term mortgage, the interest rate will not be the same interest as a 30-year. It's ludicrous that people are crunching numbers thinking that it will be the same. It's not. So here's an example showing what I was talking about. So the same $500,000 house at a 7% interest rate, which pretty much makes sense, it would be around $3,008 in payments. So it's actually more. And then, again, 50-year term mortgage. So the total interest payments would be $1,005,065. That is an insane amount of money, guys. And this is why I am bearish on this whole 50-year term mortgage. I don't think it's actually going to be helping people whatsoever buying homes. And I don't know the solution, to be quite frank with you. I don't. But I know a 50-year mortgage is not going to help anyone but the banks, and it's going to enslave the American people, the American taxpayer, even more. Now, here's another post by High Yield Hustle. It says the difference between high yield the right way and high yield the wrong way. Basic mistakes can kill your capital. Intelligent income investing can create a money printer. Let's break it down. The first one is the capital killers. These mistakes can trap you in a cycle of losing money. Fund hopping, yield chasing, poor portfolio allocation, bad entries, blind reinvestment, and poor underlyings. The next is the money printer. These habits create sustainable gains. Pivot strategically, take your dividends as cash, wait for opportunity, entries over hype, identifying the best funds, and quality holdings over yield hype. These two are so true. I have been a victim of the capital killer when I invested into blocks. Again, I am not bashing blocks. I'm actually very bullish long term for blocks, at least at the present state and how it's been managed and how it's going. However, I had a bad entry. I bought the top. I shared this with you guys. Same thing with Eggy. I got a bad entry. Again, I bought the top, guys. There is no benefit to buying the top, especially when you went in as much as I did. It's better to wait for a pullback, strategically invest, and if you can, possibly DCA down if there's more opportunities, more pullbacks, more corrections. And then don't blindly reinvest the dividends. Stack them up like I mentioned earlier in my strategy and do manual drip. Also, again, you definitely don't want poor underlyings. That's a terrible move. It's going to end up resulting in you losing more money than you're making in distributions. Next, it is key to identify bad habits you have as an income investor to break the cycle. So how does a capital killer invest? They see a fund, get hype for a crazy yield, and that everyone is talking about it. Then they buy the top, pile all their money into one fund, and set it to drip. Instead of pivoting when their thesis is broken, they double down, hoping for a turnaround. After long, they can't take it anymore. They see a new fund getting all the hype and sell at a loss to full port the next best thing. This is what I'm talking about, guys. How does the intelligent income investor operate? They anchor in the best of the best funds. How do they know these are the best? By understanding option strategies, an investor knows what is set up for success. They take dividends as cash to buy only on opportunity. If a fund they hold runs cool, no need to invest more there. If it gets back down to average cost, then it's time to buy. They don't full port, but instead hold a wide variety of underlyings. BTC, indexes, blue chip companies, quality growth names, and diversify by strategy as well. They don't hold falling knives hoping for a turnaround. If the thesis is broken, they are out and onto a better opportunity. This is 100%. You do need to stick to your rules. You need to know what mistakes you're making, and you need to be very strategic. You need to pick good funds that have great underlyings, that have good strategies that are sustainable long-term. Don't chase the hype, don't chase the yield, and make sure that you plan your entry. And I know a lot of people say, well, it's going to keep going. It's going to keep going. Look, that's what they said about most of these funds. We've seen pullbacks. I've even said it, right? For WPay, there's been a pullback. You were able to buy below entry if you waited patiently versus so many people bought the top and then they had to DCA down and they're in the negative. Not because WPay is not a good fund, but because they rushed and bought into the hype. Same thing with blocks. I was a victim of this. However, I cut my losses really quickly and I'm glad I did because it ended up dipping so down that I would be at even more of a loss, even with the distributions. And it's not because blocks is not a good fund. It's just strictly poor planning, poor execution, and poor entry. All the keys to success come down to habits. You can enter a capital killing cycle or become a money printer purely at a habit. Ask yourself, is my conviction true conviction or the amount of capital I have in a fund? Oh, that's a good one. If it's the second, cut it. Research and find something better. My convictions are true for the following reasons. I understand strategy and the fund manager's ability to carry it out. I know my underlying assets and companies like the back of my hand. I know the pros and cons to all of my holdings. I know how to mitigate each con and maximize each pro. I always buy the fund at the price I want it at, not just because I want more of that fund. Anyone, absolutely anyone can flip from a capital killer to a money printer if they create the right habits. Doing so consistently leads to consistent gains as well as being decades closer to freedom. So yeah, guys, this is something so crucial. That's why I wanted to share this. I want to always just share something of value for you guys, plant some new ideas that potentially you guys can either learn from as I'm learning along the way as well. Like I don't come from the high yield income ETF space. I'm not an expert in this. You know, I've done my traditional dividend investments in my traditional retirement accounts, and I've also been in the crypto space where I've done some DeFi and etc. But high yield income ETFs, this is all new to me. I'm learning, and I hope you guys are learning with me and joining me on this journey. But again, none of this is financial advice. This is strictly my opinion, and I'm just sharing this for entertainment purposes only. Hopping into a post by Richie B, aka Wanna Be Fresh, it says quick updates and reminders. Stock futures are trading flat. The Senate has voted to reopen the government, but the House still needs to approve it before it goes to Trump for signature. The vote could happen as early as Wednesday, which is today, meaning the government could reopen by Thursday. Could, not is, could. The stock market is open for Veterans Day, but the bond market remains closed. So again, just a reminder, nothing is set in stone yet. We are still on rocky waters. We are still on eggshells, and we need to be very cautious, very vigilant. So monitor your portfolios. Make sure that you have a plan to execute should things go to positive and also should things go to the negative. Next, I have this post from Ambassador of Quan. It says 2 income models, same 10K, same 400 shares. All income shown is after the 22% tax hit and no reinvestment. Assumptions, read this first. Starting capital, 10K. Share price, $25, which is 400 shares. Time horizon, 2 years, 104 weekly periods. Payout cadence, weekly. Tax rate, 22%. Income shown after tax. No drip, all income taken as cash. Option A, 80% yield and 40% price decay annualized. Option B, 36% yield with a 6% price growth annualized. Year 1, side by side. Option A, high yield and high decay. 80% annual yield, 40% annual decay. After tax income, year 1, $5,159.17. End of year 1 value, $6,692.84. Total year 1 after tax, distro, and capital, $11,852.01. Okay? Option B, lower yield and stable growth. 36% annual yield plus 6% annual growth. After tax income, year 1, $2,892.23. End of year 1 value, $10,617.99. Total year 1 after tax, distro, and capital, $13,510.22. Summary of year 1. Option A wins on income, big time. Option B wins on capital, dominant. Option B wins on total benefit, slightly. Winner. Option B, but close enough that high yield can feel better short term. Year 2, side by side. Option A, after tax income is $3,452.95. End of year value, $4,479.41. Total year 1 after tax, distro plus capital, $7,009. I think I meant year 2 here. $7,932.36. Option B, after tax income, $3,070.97. End of year 2 value, $11,274.19. Total year 1 after tax, distro plus capital, and I think that means year 2 technically, $14,345.16. Summary of year 2, option A's income falls sharply because the price base is melting. Option B's income grows because price grows. Option B absolutely dominates on capital and total return. Winner, option B by a massive margin. What do you think about this? Let me know. So this is actually a very true statement. I don't know if I've actually talked about this enough, but I'm going to say something a little bit bold. I'm not 100% sure that high yield ETFs are what we should hold long term. I think you're going to always have to potentially rotate between funds and kind of move on to the thing that serves you best and is working the most. Because again, these are new funds. These haven't been around like more traditional ETFs. But I will say, if you're getting 30%, that's also a high yield ETF. However, it's a lot more sustainable in terms of the payout and etc. That's why you can look at things like KYLD. And again, none of this is suggestions. I'm just giving an example. You can look at funds like KYLD, Blocks, QQQI, and others, and those are giving a lot more of a healthier payout versus, something that is kind of egregious, to be honest. But of course, it depends on how you play it. If you're holding long term and if there actually is NAV decay, high decay, then yes, you're going to be losing in the long run. But if there isn't any NAV decay and you could at least maintain NAV stability or even NAV appreciation or NAV growth, then you're winning. This is actually a very important case study to look at and review. And it's a big reason why you need to properly allocate your portfolio. That way you're getting the benefits of both worlds. You're getting the best of both worlds, right? Maybe having a split in your portfolio, having a 30 to 40% option B strategy, and then the remaining 60 to 70% could be option A if you want to kind of get more of that high yield income. It really just depends on what your goals and strategies are overall. Last, I wanted to hop into Yahoo Finance, and I'm not going to be covering any news on here today. I will say today is NVIDIA earnings, so to keep that in mind. But if we take a look at the futures today, so the S&P 500 is up 0.38%, the Dow is up 0.17%, the NASDAQ 0.64%, Russell 0.21%, the VIX is down negative 2.33%, and gold is up 0.35%. So I think it's safe to say pre-market at least, everything's looking slightly green. So maybe we will see a green day today potentially, or some chopping sideways. But overall, you do need to be mindful if you're in any NVIDIA positions, people might be taking profits today, especially right before earnings gets announced. Anyways, guys, I hope you enjoyed today's video, but I wanted to cover some key components and some things that I think are very important, as well as give you guys an update on the portfolio as a whole. If you guys are new here and you still haven't subscribed yet, please smash that subscribe button. I would really appreciate it. And if you aren't new here, but you've been watching my videos and you just haven't subscribed, I would really appreciate it if you could join me on this journey. You could click that subscribe button. And most importantly, everybody, if you haven't already, smash that like button. It does go a long way. But if you have any further questions, suggestions, feedback, or anything, comment them down below. And without further ado, until next time, guys, peace.